news is it's not totally true that you can withdraw your CPF at 55.
The government will take some of the CPF money and put it into a retirement account.
Yeah, I mean that's always.
I don't know, government.
Welcome to Coffee Tea Money Talks. I'm Ben, Lenin, Keiran, and Estelle.
你忘了我的名字
Today we'll be talking about what happens when you turn 55, because in Singapore, 55 is actually one of the milestones.
I think it's one of the magical age that we can finally touch about CPF money.
Yes.
After contributing so long to CPF, right? 55 is always a magic age or magic number that I tell my clients that, hey, this is the time that we are able to finally touch this money that we have been, setting aside for so long. Yeah, so maybe we can start with, Ben, share a little bit more about, let's say, if you're planning for clients who are nearing to 55, they are 50 this year, what are things to look out for when it comes to planning for their retirement?
So most people know that upon turning 55, the government will take some of the CPF money and put it into a retirement account. So what I plan to tell them is to ensure that they definitely try to meet the CPF targets. They have the basic, enhanced, and full. So as long as client has that, then with whatever that they have left over, we will try to find a way to ensure that there'll be adequate cash flow during their retirement ages.
Is there like a step that you follow when it comes to that or not?
Normally, we will try to figure out the expenses of the client, and then from there, we will either pump it up or bring it down according to how they would like to adjust for their lifestyle. And then with a aggregate figure, we will do the planning.
Estelle, how about yourself? How do you actually run through the steps?
Actually, one misconception is that at 55, I can withdraw my CPF.
Correct. Every time people will say this, hey, when how much to withdraw?
That's the common question that people will start asking lah.
Waiting for so long already.
Correct,
Yeah.
true.
The sad news is it's not totally true that you can withdraw your CPF at 55. Because number one, have you meet your minimum sum? Number two, you also need to take into account, are you still paying your mortgage? Because if you have not fulfilled your minimum sum, they will not only take from your special account, they will even go to your ordinary account and wipe out a certain amount if you cannot fulfill. And then it will affect your mortgage payment because some people are relying on their ordinary account to pay for mortgage. So it's a bigger question mark rather than a big gift waiting for you.
So what you are saying is that the amount to be set aside at 55 for this retirement account is coming from special account and ordinary account.
Yeah, so first they will look into the special account to fulfill the CPF minimum sum. Ben, what's the current CPF minimum sum?
Wow, that's a very good question. I'm too young to know that question. Don't know the answer. Hey, Lenin.
They'll first look at your special account. For example, if your special account only have 100,000, so we are going to fulfill the other, because 205 minus 100 still got 105 left, right? 105,000 that they need to source from somewhere. They will tap on your ordinary account. So be aware of that. If you are still servicing your housing loan, you might want to settle your housing loan beforehand or look into other means. But for example, there's another thing called pledging your HDB, pledging the property that you have used CPF to pay, so that you can only need to put aside 50% of the amount instead of the full amount. So there's basic, full, and enhanced for the minimum sum.
So what is recommended? So what is recommended? Yeah, I mean based on your years of experience.
You got second property now.
I don't have a second property.
Got
Don't
second
have
wife or not?
HDB.
I said got second wife or not?
No second wife.
Okay, so this really depends on individual. Some who need a lot of the cash flow, they cannot afford to lock down the CPF because some magical numbers to remember. 55, they lock down the retirement account, but you cannot touch, you cannot eat, you cannot smell it until 65. Okay? so a good 10 years period. If you still need the cash flow, you're scared you're being retrenched, you need to set aside a certain amount. You cannot touch the CPF amount unless in a very, very difficult situation where you have to appeal. So don't bank on it. You have to plan for your own retirement during this period between 55 to 65. Okay, so back to Keiran's question, do I choose the basic, do I choose the full, do I choose the enhanced? In a nutshell, if a lot of money, then you can do what you want. But if your cash flow is a bit tight, you're still paying your mortgage, your children are still young and scared retrenchment, then you may want to set aside maybe like the basic, which is 50%, or the most you only set aside 100%, because whatever, after 100%, you can actually withdraw the rest. The good news is here. If you fulfill the full minimum sum, you can withdraw the rest.
But if you just do the basic, you still cannot withdraw, right?
Can.
Also can.
If you pledge your property, if you have been using your CPF to pay for your property, there's a certain calculation that you can approach CPF board, and then you pledge your property, and then you don't need to fulfill the full minimum sum. You can just choose to fulfill 50%, which is the basic. Then the rest you can withdraw.
I see. Would there be any implication in pledging the property or not? So
Yeah, maybe tomorrow they decide to take back the property and ask you to find another place, right?
yeah, I mean that's always a
I don't
concern,
know,
right?
government.
You don't know. So I
No, we
guess
have good government.
So I think I guess the most commonly asked question is, by pledging property, what are the implications that we need to take note of? Some of the things that we may want to know as well if we are going that route. How about Ben? Maybe you know
This is
on this one.
There are a few criteria. You need to ensure that the remaining lease, there's a certain amount of remaining lease that needs to be cleared before you can pledge your property.
But even they sell the house, the CPF money will go back to the CPF account, right?
Only if they sell. If they don't
Yeah,
sell, they
they
can
don't
stay there
sell,
until they
will not
die.
be-
But the pledge criteria, I'm not touching on it. Pledge criteria, let's see the details, but you can choose to do 50%. You can.
Yeah, the implication. I guess most people are more concerned about what happens if I pledge. Is there things that I need to?
Yeah, that one I
No, this is something that you don't advocate lah. You don't advocate
It's
on
not even
pledging.
They stay in a condo lah. You ask HDB for
Yeah,
what?
he meet the full retirement sum. He
Oh,
don't
you
need
meet
to-
the full retirement sum.
No, I mean for me property is always the last thing, because ultimately it's a roof over your head. So if you are able to fulfill the full retirement sum to pledge your property, it doesn't really
Makes sense lah from your point of view lah.
From my point of view,
From a planning perspective,
Yeah.
it's not something that you will prefer lah. What are some of the implications that you might actually thought of and before you advise your clients
So
into this portion?
if you don't intend to sell your HDB or even your condo, actually it's okay to pledge your property as long as you don't sell. Even you stay in the condo or the HDB all the way until you pass away, the government is not going to snatch your place and so on. Actually, the government main intention of all these retirement CPF retirement account, CPF minimum sum is just to make sure you take care of yourself and you have a retirement. So they just don't want you to sell the property and then you take the money and squander away. So if you sell the property because you were pledged before, you need to pay back the full retirement sum. But if you don't sell, you live inside until you pass away, nothing will happen because
Actually, not too bad. Like what I'm hearing from you is that we are potentially able to unlock the money that is actually stuck.
so
in
it's
there.
for HDB and condo also.
As
I
long
thought it was-
as long as you use CPF to pay
properties, I
for any
guess,
property
so.
before. Yeah.
Learn something
Yeah,
new
yeah.
today.
But do the specific criteria that have to check the CPF board. Like Ben just now rightfully mentioned properly, the lease, remaining lease, all these. The very details have to check the criteria.
So apart from, I think CPF is the magical age, or 55 is the magical age where we are able to do something with our CPF, right? What are some of the options that you think people at that age can really consider?
Oh,
When it
but
comes
next
to-
year change already. Do you hear?
Next year, SA account to be closed.
I say the special account.
The special
Special account for
Yeah.
people who are
Why
above
why they
55.
close
You ask me, I also don't know.
Government policies,
Yeah,
right?
no policy lah.
The government policy is also because you are not supposed to have liquid your liquid, because SA was very liquid back then. When anything above your full retirement sum, you can withdraw it like a bank account in a sense.
So
they
got
found it
ATM
weird. Yeah, kind of.
CPF got ATM.
About 3 days turnaround or within 2 days. So, but they don't want you to be. They don't want, the government doesn't want to pay such a high interest rate for something that's so liquid. So if you can access it any day, but you still get paid 4% on top of it. So to the government, it didn't serve their purpose, the direction. From what I understand. I see. Yeah, so it's a good thing. But a lot of retirees are actually affected because I think it's not grandfathered. So whoever turned 55 like 10 years ago, their SA account will also be removed.
I see. What are some of the alternatives in your point of view?
You mean when
like,
the,
since
the
the SA
special
is
account?
closed, right? Then what are some of the alternatives
I mean,
that we
if
can?
you want to be equally low risk at this point of time, it will flow into your OA account. So you have 2.5% there. If not, currently T-bills and your relatively safer alternatives are your T-bills, your Singapore saving bonds. So this will still give you maybe 3%, high 2%, which is more than your OA. And at the same time, because it's government linked, it's relatively safe, so low risk. So if you're willing to take a bit more risk, then retirement plans from insurance companies will come in, and they will either pay you monthly after a certain accumulation period, or you can go the investment route.
What will be your approach if they are slightly higher risk, or don't recommend people who are higher risk to
What do you mean by high risk? They have high risk profile, or they high risk meaning they need money anytime?
Yeah, they are high risk profile and they are at 55. Do you still recommend them to take money from CPF and then invest in high risk product? What's your chain of thought?
So if they are high risk, meaning they might need money as and when, like business owners or people. I mean, at 55 is also a very good age for people to get retrenched. So if they do want that safety net, I would advise them, you can either choose to put your money in CPF, 2.5%, or just take it out in T-bills or your retirement plans. At least something that minimizes your market risk exposure.
I know somebody like to invest into NVIDIA.
NVIDIA, you mean?
Yeah.
NVIDIA lah. Personally, do you? No, I know you are slightly.
Why look at me?
Lower
What?
risk lah.
You need trust in technology. Looking for long term.
Yeah,
Especially we are all using technology products.
Yeah, that's why. You see.
Your laptops, all these require, technology to be in place lah. But how about yourself? Estelle, let's say for example, people who are of a higher risk, do you encourage people to actually take out their money?
But 55,
at 55, yes, correct. At 55, yes. So that's how.
I would think it's a good idea. I will want to go around the world. So it really depends. Some people say that, like my uncle say, wait so long already one leg in the coffin, still don't take out the money and spend later. 70 plus, even alive also cannot move already. So no point. So they rather maybe do the 50% basic minimum sum, and then they take the money. Some of them spend, some of them will set aside some money for investment, but not a good idea to spend all lah. But they do want to have a little bit of luxury and do things that they like traveling, or he has never sit in the first business class before. Okay, so I think individual, but I know it's a long time. 55 is like halfway mark. Not everybody want to wait until 65 to get their first payout. And bear in mind, your first payout at 65 is not lump sum. It's like a pension where monthly payout. And you also cannot control the money. Yeah, it's not like you want more, tomorrow you get more. You cannot. You want to go karaoke, you want more, or you want to go buy Chanel bag more, also cannot lah.
Okay. I think the other concern I want to ask, like why at 55 wouldn't people be concerned about the medical costs? I mean, if you have
medical
customer,
costs.
right? I mean, how do you advise them on this when they are 55? The escalating cost of
healthcare.
Yeah, healthcare.
Customers
Yeah.
Customer go and find financial planner.
Or how about yourself?
Yeah, how about yourself?
How do you manage this rising inflation for healthcare?
Buy insurance lor.
I mean, buy insurance, yes, correct.
correct,
But then how do you allocate? I mean, buy insurance. Everybody also know buy insurance.
Planner say, don't know, my planner tell me critical illness lah, cancer lah, and then what elder shield. But now no more elder shield, what cash shield, a lot of things lah.
So what is the percentage that you think or personally you allocate to insurance for this inflated healthcare portion? How much personally you
I actually never really tabulate because my planner just
not your main concern.
my planner just plan for me. But recently, then she go and approach me and tell me, some cancer thing not covered in the hospital plan, better buy more. What drug list some cancer drug list. So she asked me buy more. Then I look at her. I look at the policy. Okay, like a bit not so expensive. Then I buy lor. But that one no money back. I don't want to buy too much. Because last time when I'm young, I buy those like, when you give up the policy when you don't want, you get money back type. I think whole life plan. Even when I'm very, very young, that time, my first policy, I remember, it's not even whole life. It's called, I think got investment one. Investment linked policy.
Not too sure which one you're
I also don't know lah. But anyway, then what about Ben? So, for medical, how do you manage this?
Usually your shield plans would cover, but premiums would be more expensive for older folks. But because of, you need to manage your money well. So,
what's the percentage?
Percentage.
Personally, you use
Personally, for more than healthcare lah, like insurance per se lah.
Okay lah, insurance lah.
Insurance per se is about maybe 20 to 30%.
20 to 30% of your disposable income lah. Disposable income.
But it's biased also lah, cause.
30%.
Oh, that's quite a fair bit.
Quite a fair bit actually.
Then how much do you set aside for retirement after 30? Then
maybe for your mom and dad.
Part of 30 lah.
The goal isn't to similar to Lenin, where you have different pots for long term, short term for your 1 million plan, right? Mine is more of my general plan is to grow this retirement sum, and this retirement sum will be able to fit the needs for the medical, the insurance premiums, and retirement. So mine is more of a very high level approach towards the whole planning lah.
A top down approach kind of thing lah.
So I just need to make sure my money grows, and that the rate that it grows will more than cover the needs of what I need
so you
to
take
spend
the
on.
returns lah. You take the return for
You
your
can-
investment.
So I could, I have something which pays out, so it will eat into its capital and pay out upon a certain age. And I also have some which just pay out as and when, and then my lump sum is untouched. So with these payouts that I'm getting, and assuming I do get to 65, my CPF Life plus these two should be more than sufficient to cover my medical, my leisure, my house and stuff. So yeah, that's how I approach it for even with the clients.
I see. So just curious, right, Ben, if you are planning in such a way, right, are you looking at a whole sum of money, or are you looking at monthly income at 65 that you are referring to?
So I realized from my experience with my parents is the war chest approach doesn't work. So war chest meaning upon
Lump sum
65,
lah.
yeah. So you save, you invest, and then at 65 you intend to use this sum of money to last you to your death. Might be 85, 90, might be 75. So this approach doesn't really work, because if you don't have cash inflow coming out, and if inflation is very high, your war chest gets depleted very quickly. So I've been trying to convince my parents to take a dividend approach, rental approach, to help not only sustain the war chest, but in case things do happen, they still have some extra cash to spend.
So to say, I realize there's also a lot of people at age 55, they go and sell the condo, downgrade to HDB, cash out. This is the war chest.
war chest
lah.
so
they
yeah.
actually, this method, so what you are saying based on your personal experience, that it's not
sustainable.
sustainable
It's
lah.
not foolproof.
Not foolproof.
Because if inflation, like my mom just said, like price of chicken in NTUC is going up. Like it back then at her age at 55, I guess it's about $6-7. Now it's about 10 to 11. So if your
mother don't eat chicken rice, just don't need to go and buy chicken already.
Even based on that, you can see the amount of how your expenses would have increased. But if your war chest, you don't do anything with it to make it at least match how much the increase is, you lose the value of your money.
So to say at 55, also really need to start to plan for retirement.
Yes, so
it says that it's a supplement your retirement income, supplement your medical expenses,
rainy days.
and what else did I miss out? I think these are the 3 important things.
Oh, if
Day-to-day
you
expenses.
have children, maybe you want to leave for your son.
Well, then the estate planning lah, right?
So that one also will be your CPF lah. So you have the 3 options, right? You have the one that
Basic.
pays,
CPF Life lah.
yeah, CPF Life, the one that gives your dependents, no, not dependents. There's one that you
mean the
receive less.
bequest amount
Ah.
from the CPF Life?
So there's one where you get less, but the people you leave behind more.
Basic lah, that's the basic one.
Yeah, there's one that's
Standard.
equal. So you get some your bequest, the people you leave behind also
The
get
standard
some.
plan, yes.
And then there's one where you get more lah. Then you leave behind lesser lah. So it depends on.
I think the basic, the standard, and the escalating.
There are a lot of ways to do it lah. There's no one fixed way. There's no I'm correct, you're wrong, you're right, I'm wrong. So it boils down to the individual of how they want it done. So that's the beauty of planning lah. You don't need to be at the bridge to make a decision. You can already start planning before you reach the bridge.
Okay, thanks, Ben. So anyway, we wrap up. I mean, at least we know that at the age of 55, make sure that you have your minimum sum. Make sure that you have enough for your medical expenses after 55, and also what Estelle says, estate planning, so that you can leave behind for your children. So that's all for this episode. So remember to like and share our Coffee Tea Money Talk program. See you guys. Bye.
Bye.